Hello, hi everyone. I'm Shashank. So, sir will start shortly a webinar where we will be discussing about global crude trends, the volatility that has begun post-Trump era. Apart from that, the interest rate outlook, also the commodity trend, current state of global capital inflow, outflow upon government spending as well, and few other important updates. So if you have any question, we will begin our Q&A session at 4:45. You can raise your hand so that I can unmute you. Apart from that, you can type your question in Q&A question box as well. All the questions will be taken towards the end of the session. So yeah. Let's get started. We have enough member to start now. I'll share the PPT as well.
Okay, good afternoon, everyone, and thank you for joining us in the first webinar of its kind of Invest Value. And we are truly delighted to have you all to be a part of this webinar. And the idea is to have several more webinars like these to give you basically a house view on equity markets, where we see equity markets, which are the asset classes as a house that we bet on. And apart from equity markets, there are a whole host of other stuff that we are going to talk about in this webinar. So the idea of this webinar is to be able to make it more interactive and also to have an engagement where you as a partner can service your clients in a much effective and a better manner. And through these series of webinars that we are going to host, idea is to also take some of your feedback and going ahead design the future webinars depending on what and how you want the webinars to be positioned and the topics that you would like to go ahead. So as a start of the series of these webinars, the first topic that we thought we would like to take up is on, of course, equity markets. How can we not talk about equity markets in the first webinar? Because this is the one word which connects everybody and everyone wants to know about what's happening in the market, what is the growth outlook of Indian equity markets, global equity markets, so on and so forth, talk about asset classes and how one should position their clients' wealth at this current juncture when there is so much of uncertainty with relate to tariff, with relate to geopolitical uncertainty, and the fact how India is positioned as far as the domestic consumption is concerned. So keeping all this in mind, we are going to have a very short 45-minute kind of a session. I've tried to fit in as many data points as possible in this short webinar, though a lot of it we may not be able to cover in depth in this webinar. But I would be happy to connect offline with most of you if you so feel that you need any more discussion on any topic that we are discussing today. Feel free to write into our team and we will definitely get back to you and maybe have one-on-one discussion as well. So again, welcome. I do welcome you all for the first webinar of Invest Value. Thank you so much for joining. And let's start this. So the first, at the start, let's jump onto what are we going to exactly discuss in this webinar today. If we can move on to the next slide, Shashank, that will tell our viewers what exactly we are going to discuss in this webinar today. So we're going to talk a bit about equity market outlook, the risks that are there, and along with that, what are the opportunities in equity markets given the risk that is there, how to strategize position of your clients. So that is very important. And what are the inputs that you would need to grow your clients' wealth and in turn your business. And at the end of it, we'll have a quick 15-minute and interactive Q&A session as well, wherein we would be happy to solve any of your doubts or any of your discussion points if you have, or any suggestions as well. We are most welcome to take them in the last 15 minutes of this webinar. Idea is to keep it as interactive and as crisp as possible. Let's start without any delay. So the first, without discussing GDP growth, we can't move ahead. So as you can clearly see, we are talking about the global landscape here, where we are talking about how the globe is placed at this current juncture, and especially some of the developed country and the developing countries, and how India is placed amongst all of that. If you clearly take a look at the data points which are shown here, the globe is expected to grow at a rate of 3% in 2025 and maybe a 3.1% in 2026, and look at some of the growth trajectories for some of the developed countries, and vis-a-vis look at that for India, where are we positioned? We are looking at a growth of 6.4% for 2025 and a similar kind of an expectation for 2026. This places us as the fastest growing economy for at least the next 2 to 3 years. And the global inflation, which is a major dampener at this point of time. Along with that, we all know that the Trump tariff are playing its key role as well. So to say a dampener as far as the global trade is concerned, which is why a lot of downsizing of the GDP growth has been done for most of the developed and the emerging economies as well. And especially for the Eurozone, as you can clearly see, we are looking at a very tepid and a modest growth of 1 to 1.2%. And even look at that for China, which is scheduled to grow at 5% and 4.8% and 4.2%. And vis-a-vis look at that for India, how are we placed? A mammoth growth of expected growth of 6.4% on the GDP. So all of this put together, clearly it looks like India is way ahead of the curve and will continue to remain as the fastest growing economy. The only concerns that do haunt us as well is the ongoing tariff war, or maybe the clarity on the tariff front, how much tariff eventually India will be put on India, and the inflation. To tackle inflation is still a major concern. Though India is much better placed as far as inflation is concerned, we'll delve a bit deeper into it at a later stage of the webinar. But US is still fighting with inflation, and with the recent tariffs that have been imposed, inflation, if anything, is stated to stay above target. That can have an impact on the global economies as well. But having said that, as far as the growth is concerned, India is slated to be the fastest growing economy, at least for next 2 to 3 years. So that places us right on top as far as growth is concerned. Next, if we come on to the discussion, this shows how US has fared as far as the GDP is concerned, and that blue line that you see, the lighter blue line is the mean development that is projected for US, and look where they have been growing way below their mean, which is in the lighter blue line. So that clearly shows that India has that US has been under growing as far as their mean is concerned, whereas the last 3 to 4 year mean is clearly out there, which is above 2.5, which is closer to about 2.6, 2.7%, and they're growing at 1.8, 1.9%. And if anything, with the recent tariff, this is further going to have a dampener as far as the US GDP growth is concerned. So can we move on to the next one as well? So that will give us a better picture about how the Europe and the China is placed, because we really have to tackle the China, which is still second fastest growing economy, and China plus one though is playing its part. But we need to take a look at how China is scheduled to grow. China is on its way to a gradual recovery. With an expected GDP growth of 4.5% in the first quarter of CY25. Whereas if we take a look at the overall picture of 25-26, it is expected to moderate to 4.5 to about 4%. Due to, we know, the factors are very there out there in the open, which is trade restrictions is a major concern, because US is threatening to levy a heavy tariff on China as well. Along with that, they continue to face pressure from home buyer confidence. That is where they have been facing a major dampener, and it is likely to continue to see weakness as far as home confidence is concerned. And plus, they have high debt as far as developer debt is concerned, and the global equity uncertainty still persists in China. So all of this combined together, China plus one has been playing its part, and India has come to the forefront, despite the fact that there has been a lot of flake from Trump, and threatens from Trump that he wants all the companies, especially companies manufacturing, US companies manufacturing outside USA, to stop manufacturing in India. Despite that, Apple has went ahead and opened its manufacturing units in India. and is planning to expand that further in the coming years. So that shows that despite all the setbacks that the companies are getting from the Trump administration, they still are looking at India as the preferred destination for their manufacturing hub. And you name it, Tesla is here in India. Apple has already started exporting Indian-made iPhones. So the latest iPhone that Apple has been exporting, most of it is manufactured in India. And vis-a-vis, if you take a look at the growth for the entire Eurozone, that is also expected to remain tepid for the entire 2025 and 2026. Germany is expected to grow at a modest rate of 0.5% for 2025 and 1.2% for 2026, while Spain could be the fastest growing in that zone with 2.5 to 2.6 for 2025 and 1.7 to 2 for 2026. So, given the backdrop of all that is happening on the tariff front, on the geopolitical tension, and despite the fact that Trump administration has been pushing most of the companies to manufacture in US and imposing tariffs, and the slowdown that we're witnessing in China, India seems to be in the sweet spot at this point of time. Though there could be a lot of discussion point, and people can also argue that tariffs have been imposed on India as well. Despite that, we are relatively much better positioned, and companies are still looking at India as the preferred destination for manufacturing, at least in some sectors, so to speak. Moving on to the next slide quickly, Shashank. So let's talk about a bit on interest rate trajectory as well. Uh, So interest rate, as you would know, that for the longest period of time, US had remained soft on the interest rate. And after that, there came a time post-COVID that interest rates cut were announced. And after that, again, interest rates were increased. Now, the Trump administration has been pushing for a further interest rate cut, despite the fact that the Fed is not too comfortable with interest rate cuts because they know that the tariff are going to push inflation higher, and if anything they cut interest rates, inflation is going to be at an elevated price at an elevated level in the US going ahead. So though central bank has cut in US, the Fed has cut 25 basis point in September 2025, and they are looking at further more cuts in the coming quarters. Of 50 basis point rate cut is what we are expecting by the end of 2025, and maybe a 25 basis point by 2026. But again, the narrative remains that they're going to remain aggressive as far as fighting the inflation is concerned. And though they're not going to overlook growth, and financial stability is what they want to focus on, but inflation is something that they continue want to fight and want to keep a check on. A lot has to be seen whether we are going to see a 50 basis point rate cut in 2025 and 25 basis rate cut in 2026. If that happens, that can lead to another inflationary pressure, though it will push towards growth and more financial stability. But that is something that has to be very cautiously eyed on because though Fed is pushing for rate cut, but a lot of it will depend on the data point as and when it comes, especially on the inflation and the growth front. Moving on to the next slide quickly. Shashank, if you can move to the next slide. Let's talk about a bit on crude because this is something which we rely a lot on. And India as we all know, is a net exporter of crude. Net importer of crude. So crude oil prices play a major impact on the Indian economy. So as you all know that crude is little soft at this point of time, and has been oscillating in a narrow range between 60 to about $66 of late, and has been down about 4 to 7%, 4.7% month on month, and 10% year on year. So this fall in crude oil price has been actually has come as a boon for Indian economy because we are a net importer of crude. So 85% of crude requirements we import. So this has been a major helping hand as far as Indian economy is concerned. And going ahead, we don't expect crude oil to spike too much from these levels. Chances are it will remain in a band for at least the next 12 to 15 months. And OPEC is already looking at a partial output increase of 137,000 barrels per day from November 2025. So that could keep the crude oil prices under check. So we don't expect a too sharp a jump in the crude oil prices from here on, maybe a $70-$75 at max, but that too over a very long period of time. Overall, we expect crude oil prices to remain in that band of 60 to about $70 for at least 12 months going here on. So that is going to play a major benefit as far as India is concerned, because as I mentioned, 85% of its requirement, crude oil requirement, is imported, and lower crude oil price will act as a relief. The import bill of India as well was down 18% year on year at $40.4 billion, which actually played its part. The only overhang here is the depreciation in the Indian rupee that we are witnessing. We are constantly witnessing a weakness in the Indian rupee, which is currently trading around $88. So that is something that plays a dampener. While the crude oil prices are soft, the depreciation in the rupee actually plays a dampener, and plus the uncertainty as far as geopolitical tensions are concerned could keep the crude oil prices in the volatile territory. So crude oil price is going to be a major play on the Indian economy if you talk about next 12 to 18 months from here on. While we expect crude oil prices to remain soft, it is important to also take a look at some how the USD INR shapes up for next 12 to 18 months, which we are going to look at in the next slide. But overall, we don't expect too much of a shocker from crude oil price, which is going to help the Indian economy and come as a relief for the Indian economy. Now, which are the sectors to focus on while the crude oil remains soft? Auto is something that we would like to focus on when crude oil remains soft. Aviation, FMCG, and paint industry, as you all know, crude oil is a raw material for them, so a lower crude oil prices do benefit aviation, automobile, FMCG, and paint industries. So one can actually look at these sectors for next 12 to 18 months. And if you take a look at how the FMCG and the paint industry has grown, it has underperformed most of the sectors in the last 1 to 2 years. So might not be a bad idea actually to look at some of the FMCG and paint companies, given the fact that the crude oil prices will remain soft. On the flip side, upstream companies and oil and gas producers will remain under slight bit of pressure if crude oil prices remain softer and expected to remain soft. So companies who are into upstream and oil and gas production can see some bit of a decline or maybe remain sideways. Now, coming to the currency outlook, as I mentioned, largely currency has remained stable between 80 to 89 in September, and we don't expect too much of depreciation in the Indian rupee going ahead. Rather, if anything, it can remain stable around these areas of 85 to about 89 on the upside. So how does rupee actually affect the Indian economy, and who does it help? Let's quickly take a look at it. A weaker rupee usually aids in exports and helps the exporters. And if India becomes a manufacturing hub, and if it has to export, make in India and export to the outside world, be it Eurozone or maybe US or Canada or the rest of the world, a softer rupee definitely helps the exporters. So the manufacturing theme, which has been playing in India, not only for domestic but also for export, gets a good boost and is definitely a beneficial if you are a net exporter and you start manufacturing in India, which is why you will notice that China usually keeps its currency at a depreciated value, much depreciated value, because they focus on more of export rather than import, and they tend to depreciate their currency. And India, if becomes a large export market, will benefit from a softer rupee. But on the flip side, when you start importing, that actually plays a negative part if you have a depreciated rupee. And inflation risk, of course, is also there. So outlook as far as rupee is concerned, we feel that rupee will remain range bound between 80-89 to a dollar by the year end. And with RBI's intervention, steady capital inflows, we don't expect rupee to see too much of a volatility going ahead. So overall, we don't expect too much of a volatility in rupee. If anything, it can settle slightly lower, closer to about 86 and a half to about 87 to a dollar in the coming next 6 to about 7 months. What are its implications? Of course, like I mentioned, it does help the exporters a softer rupee. It helps companies like IT, pharma, textiles, and we actually are looking at supporting our textile industry after the recent tariff imposed by the Trump administration. Textile has taken beating, and we do export a lot of textiles from India. So that is something that the government is looking at quite intensively to boost the textile industry and come out with some kind of an incentive, maybe in a PLI form or other forms in the textile space. But on the flip side, like I mentioned, oil, auto, cap good slightly face negative concerns if rupee remains at a softer and depreciates even further. Overall, like I mentioned, we don't expect too much of a volatility in rupee and currency, which is going to benefit the Indian economy overall going ahead for at least 12 to 18 months. Now, let's take a look at the capital flows and how the global capital has been flowing and how the FII money has been flowing into India. As we all know, FIIs have remained net sellers in India for the longest period of time now, at least for last 1 year. If you take a look at the graph at the bottom of your screen, you will clearly see that FIs have been net sellers in India, and there are reasons for the same, because there have been uncertainty as far as tariff is concerned. FPIs have remained away from the Indian from the Indian markets, and that is likely to continue for some more time. Though, if you see, the scale of selling has cooled off. It is not to the magnitude that we're witnessing last year. But despite that, because of the uncertainty and the trade disputes, FPI will remain or may remain slightly away from the Indian markets. Even though after this, Vietnam and India remain the best markets in the emerging space and should see rather a robust growth. But overall flows, like I mentioned, are projected to remain stagnant between 2.5% of the global growth levels, which is the lowest since 2008 if you remove the recession time period. So overall, like I mentioned, the major concern for India right now is this FPI money, which is not coming into our markets. And despite the fact that we say that our domestic consumption has grown and the domestic investors in the markets have come back and are taking a large pie, FPI still to a major extent plays a major role in our markets, and we need FPI to come back in the Indian markets and give that boost to the Indian markets. So this is something that we need to eye very closely. And the quicker we have a solution on the tariff, my sense is FPI will come back to India eventually, because clearly of the fact that I mentioned at the start of the session, that India remains as the fastest growing economy. And given the backdrop of a softer crude and a lesser volatile Indian currency, we are expected to outpace the other emerging markets. So that is where we believe India will be in a sweet spot. And once the tariff wars are over, or we have certain clarity on tariff and geopolitical tension also eases, FPIs will make a comeback in India. Now, let's take a look at India macro outlook and how India is placed and what we are looking for the India's growth next 12 to 18 months. Just a second. So India is, as I mentioned earlier, also is expected to grow between 6.4% to about 6.5%, though it is slightly down from the earlier projection of 6.7% because of the tariff and the geopolitical tensions we all know. But having said that, like I've been mentioning again and again, and I've been emphasizing on it, that India remains as the fastest growing economy. And the reason for that is the domestic demand, the government capex, and the recent GST relief, the rationalization that has been done, GST rationalization and the tax relief is going to start playing its part. India remains as the fastest consumption markets. And if you take a look at the chart below, clearly shows the kind of growth that we are looking at in India. And it's going to be a major contributor for India's GDP. The major contributor for next 12 to 18 months will be the consumption market that we are seeing. And if anything, if you take a look at, we've done some channel checks as well. If you take a look at, if you talk to the distributors, the demand in the white goods space and the uptick in the car demand has come back in this festive season. It's just been the first month of the festive season, and we are witnessing a very robust demand as far as your white goods and your automobiles are concerned. Moving on to the next one, India macro outlook. We are talking also about the inflation outlook because that is something where India has done phenomenally well. If I can put that in words, we have been able to keep inflation under check. Both the food inflation and the headline inflation, though we have seen a slight uptick in both the headline and the food inflation recently. But given good monsoon season and GST rate rationalization, chances are that we are going to see favorable inflation, and that is going to augur well for our equity markets in the next 1 to 2 years. And RBI maintains an inflation at 2.6%, first citing, like I mentioned, GST rationalization and favorable food supply conditions. Just to give you in number, food inflation improved to 0.69 in August from 1.76 in July because we've seen declining vegetable prices at a slow pace. And of course, with this recent monsoon season that just concluded, which was above normal, expectations are the food inflation will remain under check. Though the headline inflation, which is excluding food and fuel, has seen a slight uptick, but that is expected to come down, and that was predominantly because of the rising gold prices. So that is something that has played its part. We believe that now inflation should remain under check, given the fact that we have had good monsoon and GST rationalization is also in place. Now, moving on from here, we need to clearly focus on the corporate earnings because this is the major driving factor if you're talking about equity markets. Apart from the fact that there are so many macro scenarios which will be in play and which are already in play, like your tariff, global inflation, global demand, geopolitical tension, crude oil prices, USD INR, and the inflation in India, all these macro scenarios are going to remain. But the one major driving factor which drives and which will continue to drive the Indian stock market and the companies are the corporate earnings, without a doubt. And it is expected that the Nifty 50 companies will grow at high single to low double digit, which is slightly, I would say, in line or maybe under the expectations of most of the analysts that we had been putting out there. And the recently the concluded quarterly results also show that there were green shoots in some sectors, while by and large they remain subdued. And if you actually take a look at some of the sectors that have shown green shoots, are the ones which are consumption driven, and chances are we'll see growth in those segments. So the domestic demand remains resilient, and which is why we are going to see a shift, a sectoral shift towards manufacturing and a consumption revival led by this tax relief and your GST rate rationalization. Now, we believe consumption is going to be the core growth driver, and that is where we have been focusing on last 6 to 7 months. And we have been designing our clients' portfolio. We've been suggesting our partners to focus on the consumption as the story. If India, if we're talking about investment in Indian equities is concerned, and that has yielded phenomenal results as far as the consumption is concerned. So just to give you a stat, the private final consumption expenditure contributed 61.4% to India's GDP in 24-25, and rural consumption is expected to play a significant role going ahead. We have seen an uptick in the rural consumption. If you talk to any of the dealers as far as your tractors sales are concerned, that has seen a sharp uptick because thanks to the above average monsoons, increased farm income, and easing inflation. So these are the three factors which are going to drive urban consumption. And the rural consumption, which had taken a step back in last 12 to 18 months, can get a fillip now, given the fact that there is a GST rate rationalization and there has been a tax relief also announced. So though the rural consumption had outpaced the urban consumption, supported by higher farm income and government initiatives, but we believe urban consumption is going to make a comeback, and a lot of premium demand, discretionary spending is going to see a recovery and a revival, including luxury goods and services and travel, which has been a major part of the consumption, urban consumption especially, is going to see a next leg of uptick. If it comes to premiumization in terms of lifestyle, in terms of retail, we are going to see a continuous uptick as far as urban consumption trend is concerned. And the travel and the tourism, the hospitality business is continuously going through probably a green patch, and that is likely to continue at least for 1 to 2 years. And we have seen a lot of government initiatives, if it is as far as capex is concerned, removing income disparity, direct transfer. All of these have led to revival in the consumption, first in the rural and now with the GST rate reduction in the urban. And like I mentioned, tax relief is also something that is going to have its major impact. So on the one hand, we have the corporate earnings, which is likely to remain slightly tepid, but yeah, an uptick is expected there, and especially in sectors where it's led by manufacturing and consumption are going to see a revival. And consumption as a theme, we believe, is the one to bet on for at least next 12 to 18 months. Moving on to the next, this is a very interesting slide, as this talks about how India is placed, uh, and currently how it was placed about 10 years back, and how we are looking at 2030, and what are the key driving factors that is going to take this consumption driver to the next level. So like I mentioned, 60% above is contributed from consumption to the GDP, and India remains as the fastest growing economy as far as domestic consumption is concerned. Now take a look at the median age population, which we have seen. So the median age, which was slightly about 26 in 2013, is now somewhere around 29 and a half, and India is likely to see a higher median population by 2023. What is very interesting is per capita income. If you clearly take a look at the per capita income that has been increasing, the pie of the upper middle class and the middle class has been increasing, and the pie of people opting for luxury has also been increasing. And that is clearly visible from this uptick in the per capita income, which is slated to touch $4,000 by 2031, and by 2024-25 it is somewhere around to 2,500, 2,600. And look at the share of population that is spending. So this is a very interesting one as well. So 64% of the population is spending now, which is likely to increase to 65 to 66%. And also, if you take a look at the household income distribution, that is also a very interesting point, because if you take a look at the jump that you are seeing from the income category of 0 to 10,000 to now shifted to 10 to 35,000. So that is clearly showing that the spending has gone up in this middle segment of the households income distribution. And that is something which is very interesting. And look at the internet penetration. All of this consumption has been driven through the internet. So in 2013, we were sitting at 12% internet penetration. We moved to 60%, and by 2030, we are looking at an 80% internet penetration. You go to any village, any town these days, everyone owns a smartphone, and they also know how to use smartphones, and internet connectivity is there thanks to so many network providers, be it Jio, be it Airtel. And this is one driving factor which has led to the growth in the consumption. The coming up of UPI, smart and fast payment system, and the internet penetration. This has led to faster growth in consumption. And also look at online shopping data. If you take a look at, from 17%, it has moved to 22%, and that is slated to reach about 30% in next 6 to 10 years. So that is also something that will lead to this consumption growth. Moving on from here on, now we'll talk a bit about the equity market outlook because we're running a little short on time. So we'll quickly jump on the equity market outlook. As you can clearly see, from 2002 onwards, the EPS has by large been increasing as far as Nifty 50 is concerned. If you're talking about valuation, right now we are somewhere around the mean valuation on the EPS. If that we talk about that, the 5-year historical PE is somewhere around 22 times. Right now, we are somewhere around those areas. It is expected that we might come down to 20 times by 2027. Right now, we are about those. So we are fairly valued. There can be an argument that some areas are trading expensive. Yes, there will be a case where some sectors, some areas will remain expensive because of the fact that they're seeing that kind of growth and that kind of government spending and that kind of orders. So those sectors will remain a little expensive, and they will continue to trade expensive also because of the lack of ideas in other sectors. But by and large, Indian markets are trading in line with the 5-year historical PE. So we don't see too much of a downside risk as far as Indian markets are concerned. The upside will also be capped. The downside will also be capped. So we believe over the next 1.5 years, Indian equity markets, especially the headline indices, will remain in a range between on the upside, you can talk about 22,000 to about 24,000. On the downside, that is what we're looking at, 24,000. And on the upside, we're looking at 26 to about 27,000. We don't see too much of an upside, too much of a downside. By and large, it will remain in that zone. Earnings outlook is expected to be between 12 to 15%, supported by your government capex. And government is also now pushing towards private capex. So we need to take a look at how the private companies are placing their capex. Once private capex comes back, then of course we will see an uptick in the earnings, and that will lead to a much better outperformance of the Indian equities. Like I mentioned, improved rural consumption and yeah, the monsoon will also help them, and of course, easing inflation. Key sectors to focus on, we believe, for next 12 to 15 years. Consumption has been one that I've been talking about from the start, and I've been pushing a lot. Apart from that, banking, finance, and industrials are something that we believe will continue to see an uptick. So banking, financials, by financials I mean NBFC space, industrials, and consumer segment is something that we believe one should clearly focus on, at least for next 1 to 2 years. Now, moving on, how are the mid caps and the small caps placed? Currently, we have seen an outperformance in the mid cap and the small cap previously, but now it is slightly outperformed Nifty to a greater extent. And now it's time for the mid cap and the small cap to maybe slightly take a backseat. While a lot of the mid and the small cap companies have been clocking an earnings of 18 to 20% vis-a-vis the Nifty's earnings of 12 to 14%. And there have been a lot of sectors within this space, especially in the manufacturing space, defense as a theme, if we talk about auto ancillaries, if we talk about consumption as a theme, if we talk about, and some of the specialty chemical theme, if we talk about. From this mid cap space, they have constantly outperformed, and they have been sectoral leaders. So mid cap and small cap as a universe overall, I believe can remain a little tepid over next 1 year, and could be the time to look at the large cap names. But yes, there will be sectors within this space that will continue to outperform. Like I mentioned, in the industrials, you can talk about capex led industrials, could be in the cap good space. Defense as a theme will continue to do well. Railways will make a comeback. We believe consumption and specialty chemicals out there as well. And plus China plus one theme, which we've been talking about, will play its part with PLI schemes, and we believe a lot more PLI beneficiaries will come in the near future, as government is planning to come up with more PLI schemes. Valuations do look a little stretched at this point of time, because they clearly have outperformed in the recent times. So that is one that one needs to watch out for. So when you're selecting mid cap and small caps for your clients or suggesting them, valuation is something that needs to be definitely looked at. Wherever you see valuations a little stretched and way ahead of the earnings, that is where one needs to be cautious and can take a judicious call whether to invest selectively in that space or not. So this is as far as your mid cap and small caps are concerned. And plus, yes, liquidity also plays a bit of a dampener here. Now, talking about sectors that could lead, that could be the leadership for next 12 to 18 months, we definitely believe that banking and financials will be the space to bet your money on for next at least 1 to 2 years, because they've remained stable more by and large. Though there were some concerns on the asset quality, and there were talks going on that banks will start showing some kind of asset class deterioration, NPS could go up, but they have remained in check. Though there has been a slight uptick in the asset quality, and NPS have gone up for some of the banks, but by and large they have remained stable. We do believe that with the RBI's constant governance and watching over banks as a hawk, banks will remain in well positioned, well capitalized, and they should continue to do well for over the next 12 to 18 months. Manufacturing as a theme, like I mentioned, will continue to do well. Government has been pushing towards Make in India. And if anything, like I mentioned, Apple is one such example where they have come and started manufacturing in India. And government is looking at targeting 25% GST contribution from manufacturing, and the focus is clearly on footwear, leather, toys, clean tech, and government is coming up with a lot of PLI schemes, and defense as well. And government is coming up with a lot of PLI and NIP schemes to boost the manufacturing in India. And over a period of time, we have seen this play out. There are a lot of companies, a lot of places, a lot of sectors which are seeing a large bump up in their orders and deliveries, and it's overall playing as per expectations on the manufacturing push is concerned. Private capex, like I mentioned, that has to go up significantly, though it has seen a 66% jump from FY22 to about FY25 at a record 6.56 trillion. But projections do indicate that there could be a slight dip, but this needs to go up for further upside, especially in the capital goods space and the manufacturing space. But we still believe that banking and manufacturing are the two sectors to bet on for next 1 to 2 years. Next, we will, as I mentioned, consumption definitely as a sector one should focus on. I won't talk much about consumption now because I've already spoken a lot on it. IT is one which is clearly seen major underperformance, clearly because of the headwinds ahead, global uncertainty, tariff, all of that has played its part, and IT has underperformed big time. And A global slowdown has been a major impact as well. But we believe IT could be now nearing a bottom out scenario. One should look at IT. A lot of job cuts has layoffs have already been happened in IT space. Going ahead, once the tariff is behind us, and sooner than later, we believe that the tariff issue will also be behind us. It will be out and done for once. Then I believe IT will be one of the major drivers, because IT predominantly has been the sector that has contributed largely to the India's GDP, which has taken a backseat in the last 1.5, 2 years because of its own reasons. Now we believe Indian IT companies will make a comeback may not be immediately, but if one is looking to position their clients' money in the safe space, which is not trading expensive and has a lot of upside with a limited downside, IT is one space we believe one should look at, because clearly there is valuation comfort, and a lot of Indian IT companies now are focusing on AI and digital transformation. which a lot till a year back or maybe a 2 year back wasn't the case. We were mostly a servicing company, a staffing company, but now we are moving from that and focusing a lot on AI, on digital transformation. And given the valuation comfort, we believe IT is one space that one should clearly look at, apart from the going theme of consumption and manufacturing, which are trading little expensive, to be honest, at this point of time. Moving ahead, this is one question that I get asked a lot, how one should position between mid cap, large cap, and small cap. Like I gave a brief about how mid caps and small caps are positioned. They will remain little volatile, especially the small caps, but there is ample opportunity there. So we believe one should clearly look at a proper allocation of between mid cap and large cap, small cap for their clients. 50 to 60% should be in large caps, or maybe slightly more if one wants 60 to 70% can be in large caps for stability, because going ahead there are still little uncertain times immediately from medium to the short to medium term time horizon. One can look at 20 to 30% in mid caps, and one should remain little light on large cap, maybe a 10 to 15% in small cap, because there the volatility will be there, but yes, the upside potential of generating an alpha is also there. So between 50 to 70% should be positioned in large caps, between 20 to 30% should be positioned in the mid caps for that alpha, and the balance should be in small cap. We still believe large caps will continue to outperform in next 1 year. Yeah, moving ahead. So now, is SIP the right route to put your clients' money? Yes, we still believe that SIP is the way to park your clients' money. If one is little confused, not all clients are market savvy. They have the information or the risk-taking ability. So what to do in times when there is uncertainty, markets are a little volatile? SIP is probably the best option, because it gives you rupee cost averaging benefit. It helps in navigating volatility. You buying all the dips in the markets if the markets are going down, because honestly nobody can time the market, and if markets are going down, SIP is the best possible route to park your clients' money in a phased manner. Even if you want to invest in the sectors that we just spoke of, I believe SIP is the right route for that. And the thematic funds has clearly seen a massive outperformance. If you follow any of the mutual fund data which is released by AMFI, of late there have been a slew of thematic funds which has been and a lot of NFOs have also come out in the recent last 1 year, and chunk of the money from domestic investors is going into these thematic funds and consumption funds and the defense manufacturing theme as a whole. And that is where a lot of valuation discomfort has also come now. So given the fact that we do still believe that the growth will be there, but because of the valuation discomfort, there could be bouts of profit taking as well. In that case, probably SIP would again be the best route to invest money in these sectors. There's a small table at the bottom of your screen which shows if you have this is the timeline of 5, 10, 15, 20, 30 years, and look at the money if you invested, and the maturity value that it will reach to. Look at the last one for 30 years. If you had invested some 36 lakhs, it comes to 3.5 crores in 30 years. So this is the kind of massive wealth creation that we're looking at in Indian markets, and this is taken into consideration a nominal return of 10,000 per month SIP if you do for 30 years. So this is with a bare minimum 10,000 rupees for 30 years. This is the kind of wealth creation that you can do through the route of SIP. You don't have to time the market. You don't have to worry about the upsides and the downsides and markets going through various cycles. Now, asset allocation is one which is also important. Equity as an asset class is not the only place rather to put your money, though this has been one of the fastest growing asset classes. And as you can see on your screen, about 13 to 14% or 15% is the average return that you get in Nifty 50 if you would have put your money in Nifty 50. But we do believe that gold, silver has also seen a massive jump. Everybody's been talking about gold and silver, and that also needs some attention. You can't clearly not look at gold and silver as an asset class. That is also one asset class which one needs to look at, and provides a beautiful hedge against inflation, against market uncertainty, global uncertainty, wars going on, tariff uncertainty. So this is a good space to park some part of your money in gold and silver. And debt, of course, is also one part to look at. Even though your clients or you yourself might have a very aggressive risk appetite, risk taking appetite, but you can't do away by not looking at debt as an instrument. Fixed income as an instrument should also be looked at. So if we actually want to do a holistic planning for our clients' portfolio, there should be a holistic asset allocation as well. And we believe with equity, gold, silver, and debt should also form part of your portfolio. The matrix could vary, or the proportion of allocation could vary depending on your client's requirement or your requirement. But yeah, overall, by and large, we believe at least these three asset classes should remain part of your portfolio. Cryptocurrencies, we don't usually have an outlook on cryptocurrencies, and because it's not a legal entity in India, we usually don't involve that as part of the portfolio. So this was it from our side. Thank you so much for patiently listening to me and giving your time. The floor is open for Q&A now. If you have any questions, either you can type it in the chat box. I'll be more than happy to take your questions one by one. And if you have anything regarding this session, you can put that as well, or any other topic that you would like to have a session the next webinar on, you can put that as well, and we would be happy to take a session on that topic as well.
Hello everyone. The floor is open for questions. So either you can raise your hand or you can simply post the question in the Q&A box as well.
Also, I would just like to take the while you are typing the question or thinking of a question, I would also like to take this opportunity to also introduce what we exactly have done in last 6 to 7 months at InvestValue, and our research partner is InvestValue Edu. We have launched a few baskets on several platforms, especially Trendline and Small Cases. These wealth baskets offer an excellent opportunity for your clients to park their money, and money managed by professionals. So we had launched about three baskets at the start of this year. One, of course, driven by consumption, though we had not forelooked about the GST rate rationalization and the tax relief. We just moment Trump came into power, we were ready with this consumption theme because we thought that domestic as a theme will play out given Trump's narrative before elections. So that basket is live on both the platforms, Small Cases and Trendline. If you want your bar for your clients, you can get in touch with us. How to subscribe? What is the theme exactly? How many stocks? Just to give you a performance glimpse, a snapshot of this basket, it has given a return of 21% in last 7 months, 8 months rather, and an alpha of 9% over Nifty 500 and an alpha of 10% over Nifty 50. We have another basket by the name of Viksit Vision, which is more focused on Make in India theme, and that has also given a massive outperformance of 14 to 15% and alpha over the benchmark indices. And the third one is an ETF basket, which is a best suited basket for an SIP for your clients. It has global markets, it has exposure to Indian equity indices, it has exposure to global indices, it also has exposure to your gold and silver precious metals as well. So it's a holistic, like I mentioned, basket of asset classes. So all three baskets are live. We will share by the end of this, after the end of this session, we will share a note, product note on these baskets. So you can take a look at that, get in touch with our team. for any further questions. Also, I'll share a concise version of this session that I took, so you have a lot of information that I just spoke of in this webinar handy with you, so that you can refer to at any point of time.
So
Okay.
we have got one question.
Yeah.
So it's from anonymous
Yeah.
person. He or she have not mentioned the name. Thank you so much for all the insight with all the factors affecting the market. I want to ask you as an investor, which sector can one bet on for the next 12 months?
Okay, so it will depend on your risk appetite, but let me give three sectors, not just one sector to bet on. Honestly, if I'm looking at just one sector, I will still go with consumption, because we still see consumption as a theme playing out for next 1 to 2 years, for the next 12 months. But if I want some kind of a cushion, like I mentioned, IT is one space which we believe is bottoming out, and you can also look at a staggered investment in both the sectors, consumption and IT. So both these sectors we believe one should look at. If you're looking at lower risk and little higher reward with a slow progressive up move, maybe IT. If you're looking for a massive outperformance immediately, maybe you can look at a consumption.
Sir, Prashant Borade has raised his hand. So I'll just unmute Prashant.
Do you have any derivative advisory services for 3 months? And yes, we do have a derivative advisory service as well. Shashank, who's been hosting this session so well, he is the one who takes care of the derivatives desk, and he's the one who heads it. So we do have service for 3 months. Do get in touch with us, and we will give you more details on that.
Yeah,
So,
hi Prashant.
I, sir, my question is that what about the AI stock and what about the data center? So, if you see the data center and AI stock has been raised last few months. So, what is your view on this?
Definitely a very good space to bet on. A very good question as well, Prashant. Data space more, I would say data centers. I think data space, you mean data centers. India is going to be at the forefront of data centers, and companies who are focusing on data centers will continue to do well, though there are very limited companies who are listed on the exchanges in this space. But yes, they will continue to do well. You have to be little selective in picking the right companies, because a lot of companies are looking at investments in data centers, but how much of it is actually playing out and comes on ground is something that you have to monitor. But yes, AI and data center as a space, we believe, is something one should look at. And from the IT space, companies who are focusing on these two areas shall start benefiting the first. So you can definitely look at data center plays and companies who are focusing on AI as well.
Okay, thank you, sir. Is there AI is a bubble if you see in a past uh, dot com, hello.
Yeah, yeah, yeah. Go ahead, go ahead. I'm listening to you.
So dot com, this is a bubble thing. So AI is a bubble or how is it?
A lot of people honestly don't understand AI, but I wouldn't say it's a bubble, because a use of AI is for real. Like when I talk about blockchain as a technology, that is for real. Blockchain is not a bubble. Similarly, AI is not a bubble, but yes, a lot of companies without using AI claim to be AI enabled or using AI. So you have to look at some of the companies, and especially large cap companies, when they talk about AI, they will be focusing on AI. So that is why, like I mentioned, a lot of companies are talking about AI and data centers, but you have to look whether they are actually using AI or getting into AI. They're getting any work done using the AI. So a lot of US companies, you will notice, are getting orders or projects because of their AI capability. Once Indian tech companies start getting orders or projects using their AI capabilities that they have built, that is when you realize, yes, Indian companies are also right there as far as AI as a technology and use case is concerned. But I won't say it's a bubble. Technology is for real. A lot of companies are saying they're doing AI, but a lot of it is yet to materialize on ground, honestly.
Okay, thank you, sir. Yeah.
Thank you, Prashant. So we have got another question. Which type of mutual fund will perform well between 2 to 3 years from now?
Okay, great one. So we believe that a flexi cap is a good form of a mutual fund to look at because that takes exposure to your all asset classes, so to say, and flexi cap should be one type of mutual fund to look at. Apart from that, if you are looking at yourself allocating a mix of large cap, mid cap, and small cap can be a good one to look at. Some part of the money can be allocated to balance advantage funds as well. I would strongly suggest stay away from sectoral funds if you don't have the knowledge, appetite, or the know-how to understand the cycles of these sectors, because every sector has a cycle. So stay away from any kind of sectoral or thematic funds. Focus on a flexi cap or a balanced advantage fund can make a good mix of these two funds.
We have got question from Jay. What's your view on investment part for the next 2 3 years on gold and silver after this big rally this year?
Okay, so if you honestly ask me, there are a lot of data points both on gold and silver which suggest that the rally has been too steep and too sharp. And going ahead purely from a risk to reward perspective, it doesn't really make sense to take a fresh exposure in this space at this point of time. But does that mean that they will not outperform? No, clearly no. They will go under lull phase for some time correction, some price correction, of course, will happen. Also, if you take a look at some of the ratios, which is a Dow over gold or maybe a USD over gold, they all show that the ratio is trading at an all-time high. And which clearly tells me that right now is maybe not the right time to allocate a lot of money in gold and silver. You can start an SIP, yes, because that will give you average rupee averaging cost effect as well. And we believe that over next 6 to 7 months at least, they will start softening from these prices. The upside could be 5 to 10%, the downside could be much higher in gold and silver. So an SIP route will be better than a lump sum investment at this point of time.
We have got another good question. FIIs has been a net seller generally, but with this DI's inflow in this market, is that even a concern also? When do you think this can stabilize? Any other factor other than Trump tariff is the reason behind FIIs selling?
Predominantly, it's been the Trump tariff, which has also kept the dollar at an elevated level, which is why you're seeing this kind of an FPI outflow from India. Apart from that, yes, the geopolitical tension is also a concern because that keeps the crude oil prices also at an elevated level. So these two factors are not good for India, which is why FPIs by and large have remained away from India. And when there is uncertainty, lack of clarity, FPIs usually tend to stay away from emerging company economies and emerging markets. But once we believe that there is more clarity on tariff and geopolitical tension now seems to be abating a bit, crude oil should remain stable. The USD INR should also remain stable. FPIs will make a comeback. Like I mentioned, India remains the strongest growing economy and the fastest growing economy. So FPIs will make a comeback sooner or later. And yes, strong domestic inflow has helped the market from a major downfall, but we still are little dependent on the FPI money. I can't rule that out.
So we have got the last question. What is the role of an SIP in client's portfolio strategy, particularly when dealing with market volatility?
Okay, so which is predominantly why you need an SIP, because when markets are going through a volatile phase, uncertain phase, and we clearly don't know which way the markets will trend for at least next 1 to 2 years, SIP gives you that advantage of averaging your investment at a lower level. So whenever you see markets correcting a bit, your next SIP goes at a lower level, or when markets even surprises you on the upside, your SIP, even if it gets triggered at a higher level, your average will always remain below the current market price. So the SIP actually caters to both these scenarios when markets are little uncertain, you're not sure about what is going to happen in the market, and over a period of time you remain invested in the market. See, honestly, you can't do away by not remaining invested in the market. Nobody has been able to survive the market or been able to make the money by remaining on the sidelines. So SIP is the best route because it takes care of your cost averaging, and second, whenever you see an upside, definitely it plays its part.
We have got another question. What's your view on Geo BlackRock FlexiCap?
It is definitely going to be a major, I would say, a competitor for the two largest flexi caps that are already there in the market, Parag Parikh and HDFC. And plus, with BlackRock's technology and expertise, they will take a good market share in a market pie. One to look at definitely. Before investment, please read their offer documents, also the scheme details, which will give details about how they are going to invest, where they're going to invest. If I'm not wrong, they're also going to take exposure to derivatives, which is a slightly riskier asset class. If you're a pure play retail investor and you're looking at not taking too much of a risk, so do read their scheme documents clearly before investing into this BlackRock FlexiCap. But yes, it's a big name, and I'm sure they've done their homework. They can be looked at once they are out there in the market.
Yes, Prashant, you can ask your question.
Sir, you just said you have a derivative sector. I mean derivative segment.
Yes.
So
Yeah.
what percentage you will commit to us in this derivative sector, or what is your ratio?
I didn't get by your question clearly. If you can
You
repeat
just
it.
said uh,
We have a derivative desk, right?
Dex. So what percentage you will commit to us? I mean profit percentage. Yeah, profit
Okay. So there is no commitment as such as far as profit. Are you talking about the returns?
returns. Yeah, yeah, returns.
There is no guarantee of returns, Prashant, to be honest. We can talk about the strike rates and the hit ratios of the previous calls and the average return that past 1 year the calls are generated. But again, there is no assurance of profitability. I can't tell you that I'll give you a 30%, 40% kind of a return because that is not something that I would like to focus too much on. It's more on quality than quantity is what we focus on. And if you want more details, the you can team will give you all the details of the calls that have been given in the past 1 year and what has been the performance of it. So you'll get a
Okay,
fair
good.
idea.
Okay, do you have a AI for PMS
Hmm.
type of services?
No, we don't use AI just yet.
AIF,
AIF.
yeah, AIF and PMS.
Yes, we do have AIF and PMS. The concerned team will get in touch with you for this.
Yeah, sir. Thank you, sir. Yeah.
Okay.
Huh.
Thank you, Prashant. We have got one question from Malik. If the manufacturing and consumption boom continues for next 3 to 5 years, which supporting industries or sectors are towards become the next big investment story?
In the manufacturing, the consumption boom continues for next with supporting industry sectors. These are the sectors, Malik, manufacturing and consumption. They are sectors and industries that will continue. If you're talking about stock specific, unfortunately, I can't talk stock in this webinar at this point of time. But yes, they will be the next big sectors and continue to see growth. And within manufacturing also, there are certain specific sectors that you have to look for, not all sectors. And within consumption also, there are a few specific sectors that you have to look at. Like we're not looking at staples. We are still looking at auto ancillaries. We are looking at retail as a space. We are looking at aviation and hospitality as a space within consumption. And as far as manufacturing is concerned, we are still looking at defense and railways as a space. And recently, we started looking at your capital goods as a space and also transmission as a space. EPC players basically.
Yeah, we are done with questions now.
Okay. Thank you so much, everyone, for being a part of this first webinar. It was a privilege to have you all, and I hope that this did prove to be little insightful, or maybe some of your queries, if you had any, were resolved through this webinar. Please do let us know if any specific topic you're looking at for the next webinar. We will take that up as well. And if there is no specific topic that you have in this webinar, we will definitely have a new topic and a new webinar in the coming months. Thank you so much again for joining. Have a good day, and see you all in the next webinar. Thank you.
Thank you, everyone. Thank you for joining.